Okay, this is Chapter 12, Mutual Funds, Exchange-Traded Funds. This is a quick chapter. It's not as long as some of the others, but it has a lot of information in it, particularly important to you if you are planning on saving for retirement. Most companies will provide for you a 401k or 403b, which a vehicle that you could use to save a tax-free money for retirement. Unfortunately, in these vehicles, they generally only allow you to invest in mutual funds. They don't let you buy individual stocks. Well, some select plans may have a broker window, but most 401k plans will just give you about anywhere from 10 to 30 mutual funds to choose from. So, like it or not, even if you never intended or wanted to own mutual funds, it's going to be a necessity for your retirement, because that's really going to be one of the only vehicles that you're going to have in your retirement planning. Now remember, I had, probably next class I'll show you the formula on how to make sure you can save anywhere from $4 to $14 million in your retirement using a 401k. So I'll show you we'll put in some probabilities of what you need to save and what the returns would look like, an average compounding rate of retirement, to give you an idea of. Oh, Jesus. Is everyone okay in here? It's just sneezing and coughing. It's that time of year. Do you have the flu?
I have bronchitis.
Okay, that would explain some of your absences from class. Well, I'm glad you're sort of feeling better. Yeah, bronchitis is tough. But that's why it's good that most people are home today, not in class, because if this room had 60 people in it, and guess with these windows locked, it gets to be a little dangerous. All right, so as you can see, I'm recording this for you. It's not not reusing it for any purposes. But I do put it on the internet, and sometimes I get 7 views. So hopefully those are people in the class. Still, no one's liked one of these videos. Oh wait, the last video someone liked because it had a picture of me on it, and they said you're cute. So, but that was my mom, so I don't really count. Okay, so in this chapter we're going to look at the basic features of mutual funds, what they have to offer you as an investment. We distinguish between open and closed-ended mutual funds, two very different types of mutual funds. Exchange-traded funds, ETFs, which are very popular now, and other types of professionally managed vehicles that you can invest in. How they can fill your investment objectives, we'll talk about. Services they can give you as an investor that you can't get from stocks. And different sources of return and computing rates of return for mutual fund investments, which will be something key for your retirement. Okay. So the first mutual fund was started in 1924. And that was before a lot of regulation, before any regulation in mutual funds, and before most regulation on stocks. By 1940, there were 68 mutual funds, and by 2011, there was 8,600 with over $11 trillion of assets under management. Today, it's closer to 10,000 different types of mutual funds. So there's almost as many mutual funds as there are stocks on the New York Stock Exchange. That's how many there are. Okay. And 40 to 50% of households in the United States have some investment in mutual funds. This is mutual fund investing is one of the things that stocks were very sluggish in the 70s, and they started to take off in the 80s, and they really exploded in the 90s with 5 years of double-digit returns on stocks. And a lot of that was the ending of pension programs and defined retirement benefits from companies. Companies used to just go and say, you work for us for X amount of years, and then we will fund your retirement. And you didn't have to take any money out of your paycheck or worry about any investments or mutual funds. They just did it for you, and you retired on a pension. In the 80s, that all changed. And it's been continuing up until today, where these plans become rarer and rarer and rarer as companies aren't able to fund them or companies aren't willing to support them. So most people in this country had to switch over to a 401k, which means you put your own money into a tax-free account. Some companies will contribute, and those are invested in mutual funds. So as most Americans started controlling their own investments and placing money in mutual funds, that created a lot of excess demand for stocks. And we had this huge run-up in stocks in the 1990s. We had the lost decade of the 2000s, from 2000 to 2009, where stocks had two major crashes and two major recessions and just all sorts of accounting and legal irregularities of stocks. It just really had one of rare decades of 0% return on stocks. And now we're in this new decade, and stocks are looking good again. We've had a huge run up in stocks for 5 years, and things have been pretty good. So overall, total household wealth in stocks has never been higher than it is today. Okay, so what's attractive about these mutual funds? They're professionally managed by people who took an investment course in a college and graduated and then went to work for one of these mutual fund companies. So professionally managed people run these. You can invest very small amounts. They do offer you a lot of service as far as automatic reinvestment of dividends, withdrawal plans, exchange privileges. They're very convenient, easy to buy. They give a lot of marketing material, a lot of information, and that they will dispense to you. They keep you updated with, usually some sort of email or physical mail on what they're doing in the economy. And as I told you a week or so ago, I went to the Barron's Mutual Fund Conference, which is an investing conference. And there, all the mutual fund managers talk. They invite the companies in to talk to investors and tell them what the companies are doing and their future prospects. And I guess mutual funds are so lucrative. They have, performances from. Let's see, this year they had Paul McCartney. In past years they had usually just top-level performance that the mutual fund managers themselves pay for out of their own money, is what they claim. They don't use the profits of the mutual fund company, so they'll take part of their salary to fund. I mean, the one guy who started this mutual fund family, he's a billionaire, so he can afford it. So he, other years they've had like Bon Jovi, Bruce Springsteen, top name talent. But you have to understand too, when I go, I'm probably the youngest person there, so they're not going to have whatever you young folks listen to today. I'm not sure what that is, right? She herself is a big fan of Taylor Swift, so she's been to all her concerts and has all her albums. I'm just kidding. She's all embarrassed. I don't know, was that embarrassing to like Taylor Swift? No? Okay. Shake it off. Shake it off. All right, so the drawbacks for mutual funds are substantial transaction costs. They charge a lot. Management fees, commission fees, loads. So I was looking at this one mutual fund the other day, getting ready for the class, and I was looking at this mutual fund that invested in momentum stocks, which I thought was a unique feature for mutual funds. And I think it was almost 5% of whatever the return was that they take in the combination of fees and loads. So if the mutual fund returns 20%, 5% goes to the people running it. And then the other 15% you get. So that means if the mutual fund returns 0%, you're down 5% because they still take 5% of the fund, total fund value. So it can be very expensive. So you really want to check out the cost, especially some of these smaller mutual funds. The bigger mutual funds, they generally have a wide family of different funds to offer you, and inside those families, they usually have lower cost transaction funds that you can invest in that are, if they're index funds or non-managed funds, it could be less than 1% fees that they charge you to be involved. And some of them can go much higher, so you really want to know what the transaction costs. And they have a much lower than market performance. So if you have mutual fund managers, majority of the time cannot beat the indexes that they're most closest to. So if you're a mutual fund manager and you're putting up together large companies and you're close to the S&P 500, most of those mutual fund managers have a hard time beating the returns of the S&P 500. So if you think about that, not only they can't beat the S&P 500, but you're paying them more money than if you simply just put your money in the S&P 500 index or ETF that was non-managed and have very low transaction fees. Here's a nice colorful pie chart for you to stimulate your visual cortex. But this is a breakdown of performance of managed mutual funds versus market benchmarks. And I'm not really sure what this indicates. This is a new slide. So we're going to go through. We're going to power through that slide. It's not a very descriptive slide. I think I know what it means, but I don't want to say, in case I'm wrong, and then I get all the trolls on the internet bashing me. Right? So management companies, they run the daily operations. So this is a big operation. So they got tons of employees, and they manage all the customer service, they manage all the legal, the accounting, all the research, the investments, the promotion, advertising. It runs just like a regular company. And they have operations, they have sales, they have advertising, they have finance, accounting, human resources. So there are a lot of people employed by these mutual funds, which means they got to charge you. That's where these fees come from. They charge you these fees so they can pay everybody to run and organize these funds. So they have investors, advisors that buy and sell stocks and bonds and oversees the portfolio. So they'll have a team of mutual fund investment advisors who will cover certain industries, look at different opportunities, come together in meetings, and just discuss what they're going to buy and sell. But ultimately, generally there's one mutual fund manager in charge who makes the ultimate decision, and his job is closely tied to the performance of the mutual fund. So if he underperforms the mutual fund compared to his competitors in the index, and he does that for a number of years, a certain amount of funds will flow out. Mutual fund investors are very fickle, and if they feel like they're getting underperforming, they'll start pulling their money out and put their money in the next hottest mutual fund. And that sort of activity is what gives a mutual fund investor an average return of about 2%. Where the market's average return is about 10%, mutual fund investors generally have a 2% return because they're constantly buying high and selling low. You know, they buy a hot mutual fund when it's riding high, and then when things sour, they're quick to sell when it's low. And this is why that's why if you go into a 401k and you pick your diversified set of 5 to 8 mutual funds, you're better off just leaving your money in it and never moving it. You know, unless, the fund itself sometimes kicks a fund out, and that you have no choice but to move your money. But generally, you're probably better off not trying to play a shell game and move your money around what you think is a better mutual fund inside of that. It's just the statistics of it show not moving your money once it's in the mutual fund, you'll perform much better than trying to guess the market. Okay. So they're sort of distributors. They're going to want to sell directly to the public or through brokers, and they're the custodians of the account and the securities. So they really are the ones who are owning the securities, and they put together a pool, and you buy a piece of that pool. Now, open-ended mutual funds are the ones that you're most familiar with. If you're familiar with mutual funds at all, these are the most popular. And what's unique about these is that as more money comes into the mutual fund, they just issue more shares. So there's really no supply and demand on the share price. So if someone comes up and wants to buy 10,000 shares and there's no shares available to be sold, they just create 10,000 new shares. So there's no supply and demand pull on the mutual fund, on the open-ended mutual fund. What does change the price of the mutual fund is that they take all the assets in the mutual fund, so maybe a bunch of stocks went up that day, and it's divided by the amount of outstanding shares, and that gives you your NAV, or net asset value. And that's the price of the mutual fund. So the mutual fund is priced exactly as each share is exactly a piece of the total pie. And it goes up and down based on the value of the assets, and there's no supply and demand involved at all, because they just create new shares when they need to. Yes?
So when you mean create new shares, you mean you just buy more of the stuff that's part of the mutual fund? Or?
No, they create new shares, you give them money for the new shares. Now they have more money, and they can decide to buy a new stock with that, they can decide to keep it in cash, to do whatever they want with it. They may take your money and pay it to another investor who wants to sell some shares at a later date. So they decide, it's not like they're going to take your money and automatically buy an exact set of stocks with it. You know, they may reinvest it in another company, just really whatever they want. You know, so it's up to the mutual fund manager. He decides, where he's going to put that money. He may just keep it. If things look like they're sort of at a top, he may keep it in cash, and wait. And if things are a better buying opportunity, then he'll use it to buy. You know, but there's a constant flow of new money is what helps mutual funds stay alive, because new money comes in, they can make invest more money in a better investment or pick a new investment. And it's really difficult for these mutual fund managers when there's a crash in the market and the stock prices go down and people want to pull their money out of mutual funds. Then this is what capitulates the market and collapses it, because now the mutual fund managers have to sell the good with the bad, and they're just selling everything just to redeem, because they may lose 20, 25, 40% of the value of their fund through redemptions. People want to pull their money out because they're worried about the stock market, and now to liquidate everything to get that money back to you. And that really puts you downward pressure on good and bad stocks, mostly good stocks, because hopefully mostly good stocks, because that's what they should have in the fund. So that's why there's a certain point where the market really, when we have a bear market, that it really goes down a great deal, and that's when people are pulling their money out of mutual funds or halting the contributions to mutual funds because they feel like the market's going to go even lower. And with the open-ended mutual funds, the price is evaluated at the end of the day. So you can't get a price on the mutual fund during the day. You have to wait to the end, and it's calculated. Okay, so closed-ended mutual fund companies are different. The shares are sold like a stock in an initial public offering, and it's only that set amount. So when you buy one of the shares, it could be over or under the actual value of the assets of the company. So you could have, just to give you an example, you could have one stock. Say the mutual fund was involved in just one stock, that's $1,000. The total value of the stock is $1,000. So there's only one share that's closed-ended mutual fund. You have that one share. So, but someone else wants to buy that one share for you. That may run up the price of the closed-ended mutual fund to say $1,500, even though the assets of the fund are $1,000. So they're buying it. They're paying more from the assets of the mutual fund, because there's a supply and demand element in a closed-ended mutual fund, because it's only a fixed amount of shares. So people have to bid and compete if they want to buy into those mutual funds. But the reverse can happen. They can be undervalued if a lot of people want to sell at the same time. Then you can actually have a price on the mutual fund which is less than the actual values of the asset. Because in the closed-ended mutual funds, there's a limited number of shares. And people have to, just like a stock, put bid and ask orders in for them, and that can drive the price up or down depending on the demand. And so part of the value of the mutual fund is where the value first starts, but then the people who want to buy and sell the stock can place that value at a premium or discount based on how, what the amount of demand there is or supply. So it generally never trades at the exact value of the fund. Like an open-ended fund is always trading at the exact value of the assets. A closed-ended mutual fund can trade at a premium or a discount based on how people feel. There's sometimes I never understood why people would buy these at a premium. It makes sense to buy them when they're at a discount, and that basically happens. People just want to pull out, and their fear of it is stronger than the actual value of the assets. So that's always a good time to buy these closed-ended mutual funds, when they're undervalued. But sometimes they're undervalued because they don't have much of a future. So if it was, say, a closed-ended mutual fund that invested in a dying technology, like maybe those Mr. Coffee makers, people might be willing to sell it at a loss just to get rid of it and reinvest it in Keurig, which is the, I think Green Mountain Coffee Company makes them, which has been a phenomenal stock since they invented the Keurig and those pods. I'm afraid of the Keurig. I don't like that innovation. I just afraid of it. I prefer to grow my own coffee, harvest the beans, grind them, and then make them fresh in the percolator, the old-fashioned way. It tastes so much better than popping one of those, pods, which I'm pretty sure can contain your soul in it if you're not careful. And then you get that coffee out of it. And I've tried it a few times, it just never tasted good. It tasted like Nestle's instant coffee that you mix with a spoon. That's popular in other countries. If you're from the United States, you don't know much about instant coffee, where you just take it out of a container and you spoon it into hot water. But if you're from a different country. Anybody from a different country where instant coffee is more popular? Oh, we got 6 people here. Okay, so you understand. Right? Is my Canadian here today? No? What is with this guy? Sending him back to Toronto so he can have all the instant coffee he wants. Although actually the coffee in Toronto is really good. If you go to Tim Hortons, that's the best coffee. That's my recommendation. Okay, so we will be doing an exercise next class and calculating the premium and discount of closed-ended mutual funds to show you how you can actually calculate it yourself. Now, these are not that popular. There's not that many of them. People don't like them because they trade at premiums or discounts. They're a little bit trickier. This was just sort of, it's sort of an endangered species of mutual funds. They're still out there. They don't create many more of them, but there's still some that exist. Because most people now prefer to create ETFs, exchange-traded funds, in lieu of closed-ended mutual funds, which was sort of the grandfather of the new ETFs that are out there today. But there's some closed-ended funds I've invested in the past. You know, there was one point, I remember there was one that was on biomedical, and there was a point where people were looking really down on the biomedical stocks and had created quite a discount. That's my cue to change the slide whenever it goes black. I've been on that slide for too long. Okay, exchange-traded funds, ETFs. This is where you'll see a lot more mutual funds are going to start carrying these, and they're a great way for you as an investor who wants to invest outside of a mutual fund. You can invest in these exchange-traded funds, which are like a mutual fund. They're a basket of securities that are tied usually to a specific market index or concept, and they're more similar to index mutual funds. First, let me explain what an index mutual fund is. We talked about indexes and averages, S&P 500, the Dow, the NASDAQ 100. So they created mutual funds to exactly mimic these indexes. So if you wanted to make sure that you always had the same return as the market, you buy the S&P 500 index, which is a mutual fund that invests in the same exact stocks in the same exact proportion as the S&P 500 index. It has a much lower management fee because there is no research or management of what stocks to buy. You just buy exactly what's in the S&P 500. Now, the ETFs are like that too. They don't use the mutual fund as a vehicle. They use something closer to a stock. So they produce a share of stock that is going to represent a portion of that basket of assets. But there's a much lower transaction fees, no loads, no active management fees, so they're much more cost effective. And they trade like stocks, which means that you can do things with them that you can't do with mutual funds, like sell them short, in some cases buy and sell option contracts on them. You can see at any time of the day, you can see what the value of the ETFs are. And the ETFs have sort of been the innovation of the mutual fund area of investing in groups or portfolios of stocks. So the low management expenses makes them attractive to most investors who want to avoid the pitfalls of mutual funds. And one of the big pitfalls of mutual funds is taxes. You can't control the taxes on the mutual fund. So if a mutual fund manager, they sell a position, say Google or Chipotle or Apple, they sell a big position of that and they make a lot of profits, they don't pay any taxes, you pay the taxes. So if they sell and make a capital gains, they pass those tax burden on to you directly. So you have no control. You could buy into a mutual fund later in the year, have it go down 10%, and then be surprised that you owe taxes on a $5,000 capital gain on a mutual fund you made no money in because of the timing. That's really a bummer. But with the ETFs, you control the buying and selling they don't buy and sell inside of the exchange-traded funds. They just said, these are the stocks it's going to own, and it doesn't change. So when you go in and buy it, you control the taxes because you only pay taxes when you sell the ETF, not during the life of the ETF, which is unlike a mutual fund where every year you will have a tax obligation to the mutual fund, which is sort of why people don't worry about it so much when it's in their 401k, but you do worry about it when it's in a regular brokerage account that's taxable. Okay. The three biggest ETFs are the diamonds, spiders, and cubes. And the diamonds reflect the Dow Jones Industrial Average, the spiders reflect the S&P 500, and the cubes reflect the NASDAQ 100. So those are like the trader nicknames for them. And those are the three most actively traded, have the most option contracts on them. So they're, it can be argued that just by owning these three ETFs, you're pretty well diversified, at least in American stocks. You probably would want to add to that a fourth dimension of international stocks in the ETF. And then you could just, with 4 ETFs, you can be very well diversified at a very low cost. And you have an average return of the market. Okay, so there are different loads and no loads on funds when we talk about mutual funds. A loaded fund, they're going to charge you a commission when you buy the fund, which is, that's sort of a bummer. So you want to put $10,000 in a mutual fund to invest, and they may say, well, you need $10,500 because $500 is going to be part of the commission that you have to pay to the broker for buying the fund for you. Since people didn't like that idea of having to put more money up than they're investing, they created the no-load fund, which is a mutual fund that doesn't charge a commission when the shares are purchased. So this is something that a lot of mutual funds like, that there's no load when they first buy it. So with the amount of money that they're investing is the exact amount of money going into funds. And they have some funds that have a low fund. So they might have a low load, like 1, 2, 3%. Which is less than a typical 5% of a loaded fund. There's some loads that are tricky. They're not a front-end load, they're a back-end load. So you only pay it when you sell the mutual fund. So you put all your money in the mutual fund, and then maybe it goes from $10,000 to $40,000, and then you sell, that full $40,000 you may have to pay a 2% load back to the mutual fund company. And it's like a credit card contract. You ever get a credit card and you open up and there's this long accordion bookcase of all these smaller than anybody can possibly read on rules and regulations. Mutual funds are sort of like a contract like that. You enter into this contract and it has all this, hidden fees and abilities to collect money from you that if you're not sure of, the SEC has done a better job with mutual funds than the government has done with credit cards, with making it a little bit more simpler and a little bit more direct on giving you more information about what they're going to charge. So I can say that it's actually, if you go to the websites and look up, they do make it a little bit clearer. And the SEC was responsible for enforcing that and making them make comparisons and put up the money and give you a typical amount of money that they would charge if you were invested in the funds. Okay. So we talked about the back-end load you pay at the end, but there's also this 12B-1 fee. And they use 12B-1 to bore you, so you don't want to read it. So when you see this, 12B-1, keep going. And it doesn't say fee, but this is a fee. And basically, it's a mutual fund uses to cover the management operating costs of the fund. So it's an additional fee they charge yearly, and it's basically to pay for the advertising of the mutual fund, mostly. So for a mutual fund, it's all about how much money you can attract for the company to make money in the mutual fund. So they want to advertise heavily, and you pay for that. So that subtracts some of your return, is maybe 1% of your return goes to advertise and attract money from new people. Because it's a business, and the only way they stay alive is to grow. Okay. They do have a straight up fee just called management fee, which is going to compensate the mutual fund managers their personal salaries. They have administrative costs and fees, such as the trading expenses and being associated with different exchanges. And then, of course, lastly, which I mentioned before, you do have to pay tax. If it's not in a retirement account, you will have to pay capital gains on the dividends or any capital gains the fund develops. So if you buy a mutual fund at $12 and sell it at $15, you'll have to pay capital gains on the appreciation of the per share price, plus annual capital gains if the mutual fund managers sell and make profits on these stocks inside the mutual fund during the year. So in 1 year, if you bought a mutual fund at January 1st and sold it on December 31st, you would be responsible for paying the capital gains that the fund personally generated and any capital gains you generated from the share price of the mutual funds. Plus, you'd have to pay taxes on any dividends that the mutual fund paid directly to you as well. So there's a lot of tax obligations here. It's really a pain. That's why people prefer to have these mutual funds in a 401k account or an IRA. An IRA is an individual retirement account that you can get before you work for a company that has a 401k, or if you make a low salary. Once you make a certain salary, maybe beyond 50 or 75,000, then you're not allowed to contribute any money to an IRA. Because if your company has a 401k, whether or not you use the 401k, you're still locked out of the IRA. So if you're young and in college now and have some income, maybe work a job, it might make sense to start your IRA. You know, because you say you have to make $20,000 a year while you're in school, you can contribute, you know, a certain amount of money to this IRA and lower your tax standing and start saving for your retirement before you get your 401k at whatever company you may work at. All right. So mutual funds, generally, they'll give you some sort of table that, based on the SEC, they have to give you a table that lists out the fees and expenses so you have a better idea of how much it'll cost you, and hopefully they'll give you a chart of, if you're invested in so many years, how much these fees will add up to on a $10,000 investment. So the SEC did put some rules in place to make it a little bit more clear how much of your money is going to go to these fees over 1, 3, 5, 10 years based on a $10,000 investment. So you get an idea of how much money they're going to be taking from you. And you know, if you had $10,000 in a mutual fund, it's not uncommon to pay over $1,000 in fees and expenses to that mutual fund company in a 10-year time frame. This is an oldie but a goodie called a unit investment trust, a UIT. Sounds like some kind of disease, right? Oh no, you have a UIT. But there are the old school ETFs, and they're a unit investment trust, which is a similar idea, a pool of securities. Normally these exist more in the world of bonds, not actively managed, that you can buy a share of a trust. So it's sort of like, before they came up with the ETF idea, they came up with this UIT, which is just a different legal situation. These are all but extinct by now, and there may be a few on the edges, but ETFs are pretty much rolled over these because ETFs are much better, a more fluid and a more transparent investment vehicle compared to a UIT. So these they're just there for historical record to say at one point we had these. So they're sort of the precursor to the mutual fund and to the ETF. Now, a REIT, a real estate investment trust, is a different type of investment that has some different legal and tax-related implications. Now, the real estate investment trusts are closed-ended mutual funds, but they're specifically in real estate only. So real estate, why real estate? Because up until 2007, everybody would say real estate never goes down. The price of real estate never goes down. Always be careful when someone says never, because they said never one too many times about real estate, and in 2008 to today, real estate prices have, and depending on the market, declined up to 50% of the total value, especially in markets like Phoenix, Las Vegas, Florida, where a $300,000 condo in Florida is now worth $150,000 or less. So real estate can go down. But lucky for us now, real estate bubble has burst. Real estate went down a great deal. It's probably a good time to invest in them again. So these real estate investment trusts will just put together groupings of real estate. So for you to invest in and get part of that return. Why it's good is because if you ever try to invest in real estate by yourself and you buy a piece of real estate, you have to pay the taxes, the maintenance. You may want to rent it out. Now you have to have a maintenance manager, and if they break something or something breaks while they're living there, you have to fix it. It's just a world of headaches and expenses. So renting is, unless you're going to rent 10 units or more, it's typically not very profitable to rent on a small scale, to buy and rent things. In most markets, some select vacation markets, I mean, if you have a house to rent in, say, Key West, that's a different story. But if you're going to just rent your house or an apartment on Long Island, there's a lot of headaches and hassle that come with it. So these real estate investment trusts gives investors the ability to invest in real estate with smaller amounts of money, with a lot less hassle and stress and liability. Now, what's really unique about them is they could pull their money and invest in shopping centers or malls or hospitals or even prisons. They have some real estate investment trusts that just buy collections of prisons, and they rent the prisons back to the state and collect rental fees from the state who operate the prisons. So if, say, New York State wants to make a new prison, that's a lot of money to build a new prison. So a real estate company will actually build and make the prison and rent it to the state with like a 20, 30-year lease. And it's profitable because they're going to make sure that the money that they get renting it is going to be higher than the money they paid to build it. The state's happy because they don't have to put up the millions and millions of dollars of taxpayers' money to buy it initially, so it's like kind of like leasing a car. They get a much lower monthly payment than if they had to build it themselves. But anyway, it's still a profitable endeavor for investors to get a piece of that. You can invest in office buildings, and different other types of real estate. And some of these REITs invest just in mortgages. So if you want to just invest in mortgages and get a piece of that as well. And there's hybrids, all different combinations. So for a long time, one of the most profitable REITs were these REITs that managed sets of malls. And they would, rent the malls out, do all the management activities. So you would make the profit from all the rentals in the mall. These REITs, though, I wouldn't recommend lately because the American mall is kind of dying out. And the malls around this area are fine, but if you go to other parts of the country, or maybe if you're from other parts of the state or this country, a lot of malls are dying off and closing down and shutting down, and they're just not, due to the online realtors like Amazon and such. They're taking a lot of the sales from these stores. And how many of you have gone to, say, Barnes & Noble, found a book, then went home and bought it on Amazon? Or how many of you have seen a movie or a music CD and gone and then bought it from Amazon or downloaded it illegally? Hopefully not. But, it's really, the only thing I think left that's good for stores is clothes, because a lot of clothes, most people feel like they should try them on. But there's a whole new generation of people that are they just buy it online, and they know their size and they know the brand, and they buy it online now. So that eventually could really hurt the one remaining stronghold of these malls or these retail clothing stores, right? And all those retailers as stocks are doing terrible. Abercrombie and Finch, American Eagle Outfitter, Express, Bebe, like all these stores that had huge stocks at one time. Hot Topic, they were big stocks. Oh, gotta change the slide. They were big stocks at one time, and then they're crashing this year because their sales are going down and their profits, because rents aren't going lower, but people are buying elsewhere. All right, the hedge funds. This is something that a lot of people are confused about. What is a hedge fund, and why can't I invest in that? Well, they're not mutual funds, because mutual funds are highly regulated and highly controlled by the SEC, where hedge funds aren't. Hedge funds are by private partners, and they're more private and exclusive, and the SEC has little or no control over what they do. So they have a lot more freedom. The mutual funds have limitations where they can't buy more than a certain percentage, maybe 5% of one stock. They can't, certain things they're allowed to do and not allowed to do when they're trading. So mutual funds have limitations, where hedge funds have much less limitations. So they're not regulated like the mutual funds. So the general partner runs the fund, and they can take anywhere typically from 10% of the profits of the hedge fund. Where a mutual fund, there's sort of like a limit. You really don't go beyond 5% of all the types of fees and structures on a mutual fund. There's limits to how much they can charge you. But with a hedge fund, it can go up to 30, 40% of the returns they can take for themselves. So you get somebody who runs a very successful hedge fund, they can get billions of dollars of investments. They can grow that. Since they can use more technical and more computer-related techniques. Like you've heard about that type of trading that's, what do they call it? It's really fast trading. It's high frequency, thank you. I just couldn't get the words out. High frequency trading, which is basically getting your order in front of the other orders by a sliver of a second, so you can get that differential. But so these hedge funds have really advanced. They have some of the world's most brilliant mathematicians working for them to create these types of investment strategies to put them ahead of mutual funds. So if you're not complaining, if the guy takes 30% of the profits of the mutual fund, but he's still returning 20%, 30% of returns on the money you invested, there's no reason to complain about how much the other guy's getting, because I'm still getting double what I could get in a mutual fund. So if he wants to pay himself 30% and there's still enough money left over for me to get 30%, I'm fine with that. And then these people who start these hedge funds, if they're really successful, they generate billions and billions of dollars of profits and make these people mega wealthy from these hedge funds. Not just the investors, they become very wealthy as well, but the people who own the mutual fund become the most wealthy. So if you want to be super mega rich, make your own hedge fund and make it be successful. That's the other tricky part, having it successful. But they generally only sell to accredited investors. It's people with a greater net worth than $1 million in their net worth and an income greater than $200,000 a year. So everybody in this room, from what I would think, is excluded from that group. No comments on my own position, though. So you can't invest in a hedge fund if you wanted to. I currently don't have any investments in any hedge funds, but I would like to start my own because I would like to become super hedge fund powerful, wealthy, and then have people kiss my ass everywhere I go, hoping that some money will fall out of it, you know. Okay, so their strategies can use arbitrage strategies, which is, you know, sort of like high frequency trading, just trying to get these little differences in the market, collecting these nickels from all around the world, options, short selling, other more highly complex mathematical and computerized trading strategies that, you know, make money, and lots of money. Once they find a little niche they can exploit, they'll keep exploiting that for as long as they can. But hedge funds evolve. So the techniques, you have to stay ahead of everybody else. So once you have a good technique, other people catch on to it and start duplicating it, which makes it less effective. So then you have to find another technique. So these hedge funds, it's very rare that they're successful for multiple years on end. Some of them are, and those are the ones you want to have your money with, and those are the ones that are the most difficult. If they're a really successful hedge fund, you may have to, you know, have 10 million for your initial investment, not 1 million. So they're really for that top 1%. You heard of this 1%? That's what you want to be, the 1%. Not the 99% of us who are paying taxes and making a living and, you know, working 9 to 5. You want to be that 1%, and that 1% invests in hedge funds, and that's how they stay ahead of all the other 90% in their growth of their income, because they have this vehicle called hedge funds, which are, you know, extremely profitable. Well, most of them are. Some of them have crashed and burned, have had some bad trading techniques, and one of them, a famous one in the 90s, long-term LTCM, long-term capital management, was a hedge fund that almost destroyed the whole world. Their positions were so highly leveraged and their mechanics so risky that when we had a sort of a little economic turmoil and with foreign currencies, I think in '98, they almost brought down the world's banking system. The Federal Reserve had to lend them billions of dollars to maintain their positions until they could, until the positions came back in their favor and they could close down this hedge fund. So, you know, that got the SEC looking into, well, maybe we should regulate these things, because this one hedge fund almost blew up the whole world's financial system. There's a Nova special on it called $1 Trillion Bet. If you want to look at that online, they have, like, usually you can watch that on YouTube. It's called the $1 Trillion Bet, and explains the whole thing. Pretty interesting. Let's talk about types of mutual funds. And these are pretty obvious, but the most popular is these growth funds, the growth mutual funds, which the goal is to grow your capital and produce for you long-term capital gains, hopefully. So they're going to invest in large, well-established companies with still has a good future potential growth. And you could say, you know, maybe some companies in the fitness category are like an Apple or Chipotle or Under Armour, Starbucks, Dunkin' Donuts. I mean, these are companies that still have room to expand. You know, McDonald's is not a growth company. They're just done expanding. And Starbucks is getting close to that too. I think they have a lot of locations. But, you know, it's a little bit more risky, a little bit more aggressive, but you generally get higher average returns with a growth fund. Because growth companies is where the growth is at in their stock price, And that's going to, so if you had a good mutual fund manager that can get into some of these growth companies before everybody else does, or even before half the people do, it can have really significant returns. And if they're good at getting out of these growth companies before they fall into just a value company or a steady growth company, that's a good skill to have too. Most mutual fund managers are not successful at doing that. There could also be the aggressive growth mutual fund, which is much smaller stocks, more speculative stocks that have higher risks, but also have higher potential to have much stronger earnings. So the prices tend to be a little bit more volatile, and these aggressive mutual funds do well during stock market expansions, but do equally poorly during stock market contractions. So they're for someone who's looking for a little bit more aggressive type of investing. Maybe you're younger, and the longer you have these aggressive growth funds, the less the risk is. So it's not something to have when you're 60 and going to retire in 5 years, but maybe something to have when you're 20 and you don't have to retire for another 40, 50 years, and you have the time on your side. Now, a value fund is seeking to find stocks that have a value. Just like maybe when you go shopping, you want to find a good value. Perhaps a sweater retails for $120, but was in the bargain bin for $10. I'm kidding. It was a present. I have no idea what it cost. But just an example, it looks like a sweater that you could find for, it could either be on the racks at Banana Republic for $85 or in clearance in Marshall's for $15. But at the end of the day, it's the same sweater. So aren't you a little bit smarter if you buy clothes at a discount or at a clearance rate rather than paying full price? That's the whole philosophy with Kohl's. Everything there is marked at full price, but nobody pays full price for anything because they mark it down. So you always feel like you're making a value purchase, right? When you go to Kohl's, you're looking to buy a new dress, and it has $120 in a brand name, but you know what? It's 50% off today, and you have a 30% off special coupon, and you have Kohl's cash. So you walk out of that store with that dress for $15, and you feel like, wow, what a value purchase. What you don't know is they really paid about $4 for the dress, and they're still making a profit. Thanks to low-income labor, wherever that might be these days, keeps moving around. Let's see, where am I? Okay, so the value funds, the mutual fund managers are looking at stocks that have been beaten down. They sort of went on the clearance rack. And these mutual fund managers are sifting through the clearance rack. Have you ever been through a clearance rack? It's really humiliating because you have to stand there and look, and maybe one day you find a good piece of clothing that you could buy. Because most of it's just the trash and garbage that nobody else wanted to buy last season. So you'll understand when you get older and have to buy your own clothes and with your own money, then you may be a little bit more careful. Or if you ever go shopping with a grandparent, they go right to that clearance rack. And it's, it takes a while to get them away from there. But that's where all your nice Christmas gifts come from, and you don't even know it. So anyway, the mutual fund managers do something similar. They look through all these bargain bins of stock, and they may be able to pull out 10, 20, 100 stocks that really are going to turn around, and they really should be valued much higher. So the value funds, they're basically looking for stocks on sale that still have a really good fundamentals and value. They just kind of fell out of favor, out of style. So if a certain particular jacket or boot or something falls out of style, it's going to sell for a lot less than whatever the new hot style is. Speaking of styles, I really am against these neon colors. Do you ever see, you go to the shoe store now, all the shoes are like bright lime green or yellow, and the shirts, and you go to the gym and people are wearing these neon color. I don't get it. Neither do most of you. I don't see any of you wearing it, but you've seen these colors around, right? And it's so hard to buy a pair of sneakers these days because they're all these bright neon colors. So if you want, soon this style will go out of style. So if you want to invest in the more classic shoe companies, they'll probably come back into style when people come back to their senses. And when you're older and your kids say to you, Dad, how did you ever wear that? How embarrassing. And then it's going to be like, ever see shows on the 80s and people come out with their leg warmers and their headbands and, that we thought that was great. You'll see, today's fashions are horrible. That's why I wear this classic sweater, which never goes out of style. At least for college professors, it's always in style. You know. So equity income funds, but this is looking more on not risking your capital, but generating income. So this would look at stocks that would generate dividends, stocks that would, blue chip stocks that are high grade, less risky. It's going to generate some sort of income through dividends mostly, less volatile, just a safer bet for people who want to invest in if they don't have as long of a time horizon to invest in. They have these things called balanced funds, and it's sort of like you want to have diversity, more diversity in one type of mutual fund. This will have stocks and bonds together. So they'll have a percentage of the mutual fund that invests in stocks and a percentage that invests in bonds, and sometimes they flex them. They could grow the stock part when stocks are hot, and then if bonds become more better opportunity than stocks, they'll shrink the stock position and grow the bond position. So they play the two sides, because generally, most of the time, when stocks go up, bonds are flat or going down, and when bonds are going down, stocks are, when stocks are going down, bonds are up. So it's good if you have a skilled mutual fund manager that can kind of market time between these two different types of investment, so you can have the capital gains of stocks and the income generation of bonds. So it's a less riskier mutual fund, but generally also has lower returns associated with it. We can have the growth and income fund, and this is sort of trying to take the best of both worlds. Again, it's a balanced fund where you can have a certain amount of stocks in your mutual fund that are going to grow and also provide income, or a combination of stocks that grow, some that grow and some that provide income. So the emphasis would be more in capital gains, though. So we wouldn't be looking for those stable stocks that just stay the same price for a long term but pay decent dividends like utilities. We're looking for companies that not only are they going to grow as far as share price, but they're going to grow in their dividends as well. And it's a much more difficult class or group of stocks to find and invest in, but it will produce, it's supposed to produce higher returns. And then we have our straight up bond funds. And in this class, we don't talk much about bonds. That's more for the money and banking class, if anybody's taking that. That talks a lot about the Federal Reserve and bonds and fixed income securities and things of that nature. But as far as mutual funds, there are plenty of bond mutual funds. Treasuries, inflation protected bonds called TIPS, Treasury Inflation Protection Bonds. They're all different term treasuries. They have corporate bond funds, municipal bond funds. The primary objective is to have a fund with like bonds in it. Bonds are generally have lower returns but safer investment, lower volatility, and a little bit more reliable. So it's lower risk for investors and provides a more steady stream of income. Now, with bonds, the thing you have to worry about most with bonds is interest rates. And interest rates, when they increase, generally hurt bonds. So right now, bonds it's been an unusual time period because for the past 5 years, bonds and stocks have done well because interest rates have been going lower and being held lower for a long time. Most likely next year, they'll start to pick up a little bit. But most people believe we're in a more lower interest rate environment for, say, the next 10 years or so. But that could change as quickly as people get comfortable with that. It can change. It's sort of like, ever watch this show, The Walking Dead? As soon as you feel like it's a safe, happy scene, or they're comfortable, they're around a fire and singing, or things are looking up for them, that's when someone gets killed. And it's just the same thing with bonds. That's when, before you just think that it's so great and they're doing so well, and there's one day they get killed. The one thing I don't understand about that show is the whole premise is you need to be quiet so the zombies don't find you, but they're always yelling at each other. So it sounded like, no wonder they're getting eaten all the time. They don't understand that yelling makes zombies appear. Okay, so here are some more bond funds. We have the government bond fund we were talking about. U.S. Treasuries, these are the most popular and the most safe. And in fact, some of them are so safe, that's where we get a risk-free rate from. When we talk about risk-free rates, they're coming from these government bonds, U.S. government bonds specifically. Mortgage-backed securities, which are bonds based on mortgages, which were a terrible idea in 2007, where this is what led to a lot of the crisis, where these mortgage-backed securities, they were being sold to people who were not credit worthy. So and the problem was there was a divorce between the people who initiated the mortgages and the people who were responsible for them. So the mortgage broker would create the mortgage and sell it to you, a college student with no income and no job, and you'd be like, well, this is great, thanks for the mortgage. And the broker didn't care. He knows full well you can't pay it, but he doesn't care because he's getting his commission, and he walks away, and the bank sells it to one of these bond funds or these securitized fund groups. So now the bank's not responsible and the mortgage broker are not responsible, but these investors are responsible. And the investors have no idea of the creditworthiness of the individual mortgages because they're packed at like 1,000 to 5,000 at a time. And the idea is there's so many of them, if one goes bad, the other ones will compensate and you will notice it. Well, the problem is in some of these funds, 20% of them were bad and were never going to be paid back because they just kept lending to anybody who had a pulse. You had a pulse, and a FICO score above 400, you got a mortgage. No income required, no down payment required. Hell, we'll even waive the interest for the first 5 years. You just pay principal only, or interest only, or whatever is cheaper. Or just don't pay it at all and live in the house for 5 years before they kick you out of it. As long as we sell the mortgage. And that's what blew up the financial system, though. But before that, they're thought to be very safe and secure and never a problem. You have your high-grade corporate bonds, which are bonds based in the most stable companies. And then you have your high-yield corporate bond. And high-yield is code for junk. So junk companies, they used to call them junk bonds, but people didn't like that term, junk bonds, so they call them high-yield bonds. So these are riskier companies that are borrowing money that, in some cases, are likely not to pay them back. You have your convertible bonds, which do a magic trick. They convert from bonds into stock. So there's a provision in them at a certain point, you could cash in your bond and convert it for X amount of shares of stock. So this is good if the stock price starts to appreciate a significant amount, you may want to cash in your bond and turn it into stock. So it's a way of investing in bonds in the corporation with the ability to also take advantage of stock price over time. And those are quite popular as well. And they do have convertible bond funds. Municipal bond funds have a magic superpower, and that is that you don't have to pay taxes. So with municipal bonds, especially if you're living in the city, in the state that they're issued, you will not have to pay federal, city, or state tax on these municipal bonds. And municipal bonds, the state-issued municipal bonds are the only ones that can be completely tax-free. The government bonds, the U.S. government treasuries are tax-free only at the state level, not the federal level. Now let me reverse that. The U.S. Treasury bonds are tax-free at the government level, not the state cannot tax them, but the federal government can tax them. And the idea is about control. So if the federal government was able to tax state bonds, then they can have a certain amount of control over these states. And they could tax them so high that states wouldn't be able to issue bonds. And if states could tax federal bonds, then they can control the federal government. So the government, if they were going to issue any of these treasuries and the state was going to issue a 50% tax on them, then they would have less of an ability to raise money. So they keep them, that's where the tax-free status comes. But states are nice enough to waive the state tax as well as the federal tax on the state municipals. But you have to earn income in that state, to get that tax-free status. But they can be very useful, especially if you're part of that 1%. Say you're like a Mitt Romney, you put a lot of your money in municipal bonds and you get this tax-free income that you don't have to pay tax on because your tax bracket is very high already and you don't want to have to pay additional tax. So it's a good tax shelter for the very wealthy. Okay. Money market funds. These are very common. You may not even realize you have money in them. Now, a money market fund is something you get at a local bank, and it basically pays better than a basic savings account, a little bit better. And what they do in the money market is they invest it in very short-term securities that pay better interest than a savings account because these shorter-term treasuries, or any security really that has a very short term, typically 90 days or less, will pay, still pay more interest than a regular savings account. So they can pass it on to you. And they try to guarantee a net asset value of $1, but that is not 100% guarantee at all times. And that's what something they're worried about in 2008, that they were going to break the dollar connection on these money market funds, as even the short-term securities were in distress. But anyway, this is typically a way to have a very liquid type of investment, like a savings account, but have a slightly higher return. They generally have minimums like $10,000 to have as a minimum to invest in them, to elevate yourself from a savings account to a money market. But they're very common for just want to hold cash in a very short-term period in a very safe way. So even if you're a major corporation, you have $1 billion you're going to hold for 2 weeks, put it in a money market fund, you can make a few extra thousands of dollars on that in interest, more than the 0% savings account. So that's why. Okay. So index funds we talked about earlier, but I'm just going to restate them here. They're just based on any index that's been developed. They can have a corresponding mutual fund that mimics that index. And they just buy the same exact stocks that are in the index and call it a mutual fund. Now, a lot of the index mutual funds have come down a great deal in costs because they're competing with ETFs, which are very low cost already. And since they don't have any mutual fund, you don't really need a lot of people to manage these. You just set them up once, and there are very few, there's no actual management of trying to decide what to buy and sell and timing. So they don't need a lot of manpower to run these mutual funds. So they're run at a very low expense. So the thinking goes that if these index funds beat most mutual fund managers, then you probably should just invest in the index fund. Because the mutual fund manager may be hot for 2 or 3 years in a mutual fund, but guess what? He's not married to that job for life. He may leave that mutual fund and take a job at a bigger mutual fund. And now you're left with an unexperienced, unknown mutual fund manager who may not produce as better returns. So it's safer in some regards to have an index fund than a mutual fund because it's more consistent. But you do lose that opportunity of beating the market because some mutual fund managers can beat the market. And you will never beat the market in an index fund because it can only do as well as the market. And generally, after everything's been calculated, it does a little less in the market because there are some fees associated with it, although very low type of fees. We also have sector funds. So there are different sectors in the market. You could have energy, computers, transportation, agriculture, defense. There are tons of different industries and sectors in business. And mutual funds can actually take just one concentrated area and make a sector fund just on 20 companies in the semiconductor area, and that can be a sector fund. So a biomedical, they have lots of sector funds on that. Medical equipment makers, there's sector funds. So they can really trim it down. As long as there's at least 10 companies to string together, you can have a sector fund. And for some people, some sectors can greatly outperform the markets. So if there's a sector that's really, I saw a sector fund that was based on cloud computing and cloud storage. And that was hot for a couple of years. There was one, RFID was hot for a while, 10 years ago. So there are these trendy sector funds that can come up that can generally, hopefully boost your returns to a higher level. And if you go to any mutual fund site, they generally have a list of sectors that you can invest in. So if you had an idea of a group of companies or an industry that's going to do well, then you probably would do good with a sector company. Socially responsible mutual funds, because this new generation, and as it should be, is more conscious of social responsibilities. So they put together a mutual fund of companies that are, like Whole Foods, are socially responsible. They look to give back a certain percentage of their profits to charities, and that they try to use sustainable or renewable energy sources and things like that. You get the picture. So if you want to invest in the good guys, you invest in these socially responsible mutual funds, and that way you know that your investment isn't going into some mutual fund that slaughters cows or kills dolphins or pollutes the atmosphere, these types of things. However, they do have SIN funds. And the SIN funds will invest in tobacco, alcohol, gambling, nuclear energy, all the companies are bad for this world. And they typically have a higher return than the socially responsible funds because they don't have to worry about giving back, that pesky thing, giving back or being socially responsible. Asset allocation funds, this takes even more work out of it. They created these funds, and actually Ford helped pioneer these for their employees, and they wanted a one-stop shop. Just buy one mutual fund for your retirement. So if you're going to retire in, say, 50 years from today, or 20 or 30 years from today, there's a mutual fund you can buy. And the mutual fund managers will automatically allocate the portfolio based on your age group. So in the beginning, you hold this fund for 40 years. In the beginning, it's all stocks, and more aggressive stocks. And then it starts getting safer and safer, and towards the end, it's probably all bonds. So they do all the asset allocation changes that you would need to make throughout a lifetime when you go from a much more speculative stance when you're younger to a much more conservative stance when you're older. And these asset allocation funds will do all these built-in allocations for you by professional managers. So they will do the market timing, market considerations, put everything. You don't have to think of anything. Just put your money in this fund, and they'll do everything for you that you're supposed to do through a life of investing in your portfolio. The only drawback is they charge significantly higher fees and loads for this, since they're doing more work. They're not just putting together a group of mutual funds, a group of stocks. They're putting together a life plan for you. So they are typically going to have a higher fees. And that's the one big drawback of them. But they're very attractive to a lot of investors who don't want to think at all, do any work on their investments. Just give me, where can I put my money that you'll do everything for me? Because we're sort of turning into the do everything for me society. No one wants to do anything by themselves anymore. You have a house, you get someone to clean it for you. You have a yard, you get someone to rake the leaves for you. You have a car, you get someone to do the oil changes for you. It's getting to the point where people just, I guess, go to work, come home, watch TV. There's nothing else to do. And they like it that way. International funds. It's just like it sounds. These are funds built up of companies from around the world. Some international funds can be as small as one country. They have a fund for just Poland and just Germany. It could be, Europe. It could be Asia. It could be a mix of all different countries in all different areas. And the funds can be just as specialized: growth, value, speculative, specializing, like I said, in single countries. But the international funds give you a broader diversification. So you can't rely on one country to have all the growth anymore. Now it's a collection of companies. So everybody's investment advice always recommends that you have some international exposure in your investments to take advantage of these world opportunities. Okay. So mutual funds can they bend over backwards to make it easy for you to invest. So they can take money out of your paycheck, out of your bank account, with your permission, of course. They can take as little as $25 a month, just to keep you reinvesting. They'll reinvest your dividends, reinvest your capital gains, and when you grow to a point where you need to retire, they can have a systematic way of withdrawals from the plans. Basically, they'll sort of like give you a paycheck every week or every month. So they want to, in order to make the mutual funds more attractive to you, they'll do a lot more service for you as far as how you invest and how you pull your money out of the funds when you retire. They can let you exchange the mutual funds between family members, excluding any type of loads or fees. They have a whole customer service. You call up on the phone, ask questions, make trades. They have websites, and they usually offer education on retirement and the education of their funds and what stocks they have and things of that nature. Investors like you and me would use these to, of course, accumulate wealth, a place to store your value, and in some cases, some speculation in short-term trading. So there are some mutual funds, like right now, oil prices are going lower. So you could short an ETF based on oil prices if you want to take advantage of that. And then when you feel like oil prices are going to go up again, you can just reverse your short positions and buy long. So you can use some of these ETFs or even some mutual funds of more speculative trading based on how you feel the economy is going to move around. So if you want to select a mutual fund, it's common sense at this point. you want to increase your diversification. You want to have a sound and safe portfolio for your retirement. Mutual funds will probably get you the fastest. I think you can do it in as little as 5 different mutual funds to be diversified between small, medium, and large companies, domestic and international, bonds and stocks. All right. Let's see. And of course, if you want any information on mutual funds, it's everywhere. I would say their websites directly. If not, the Wall Street Journal, Barron's, Morningstar has mutual fund reports, Value Line mutual fund survey. Going to any brokerage, they probably have a whole host of mutual funds they offer or information. You request information from these mutual funds, they'll send you their prospectuses and portfolios and commentary. Okay, so things that if you're comparing mutual funds, you definitely want to look at the fund's past performance, not necessarily predict their future performance, but gives a good idea of where they're coming from. How, their tax efficiency, how much tax liability you have with them, the fee structure, how much, definitely how much you're going to pay on an annual basis in fees is something you need to know, especially if it's a front end or back end load, how it fits into your portfolio. A good thing to look at is to get to know the mutual fund managers, which mutual fund managers are the most skilled and have the best records, because they change mutual funds quite often, so you may want to follow them around rather than holding their particular mutual fund. You hold it until they're leaving, and then you buy their next mutual fund. And of course, sometimes doing some work on and thinking about closed-ended versus open-ended, because there might be opportunities where closed-ended funds, you're buying stocks at an extreme discount. Closed-ended funds, the NAV on that will definitely gravitate above and below the actual net asset value, but it always tends to gravitate back towards it if it gets to too low of a point. So if a closed-ended fund is 20% premium, it's definitely going to go back down to a lower premium, or even if it's a discount, when it gets to about a 20% discount, that's usually the bottom for most closed-ended, and it's going to trend back upwards. So there are people who do some trading strategies with closed-ended mutual funds. Now, the closed-ended mutual fund there's a formula with share price minus the NAV divided by the NAV. NAV is net asset value, gives us a premium or discount. We're going to do this in the next class by hand, just to kind of show you how that works. And of course, in mutual funds will give you dividends, capital gains, but any money you make in the capital gains is called a paper profit until you actually sell that mutual fund. All right. Just do a time check here. Okay, we still got 2 minutes. Okay. This is the formula calculating returns on mutual funds. We're going to be calculating this on Wednesday as well. It's a basic return formula we've learned already. We're just going to apply it to mutual funds, having some a little added nuances in there. We'll calculate it on Wednesday. Okay, so that's the end of the chapter. We made it through. We reinforced all our learning goals, and I'll see you next class.